Inspiration with Crystal podcast. I'm super excited today to have our guest, Ashley Zeller at Bank Midwest, to talk about this crazy real estate market, which I guess we've been saying for like 3 years.
It's been a while. It's been a while.
But crazy for different reasons, because right now sellers have a ton of equity, but everyone's scared of these interest rates. So explain the whole thing to everyone. No, I'm sure. Just give us an idea of what you're seeing in the mortgage.
A crash course on mortgage in how much time do we have?
Yeah. And how it works with the treasury bond. Like I'm sure.
We're going deep dive. So you're 100% right. Everyone focuses on the interest rates because interest rates is kind of the first thing that you think of.
Yeah.
I'm a payment focuser. I always focus on the payment because you can have a difference in rate and you may think it's this huge difference in payment and it may only be very slight difference in payment. So I like
That's a great idea.
I like putting some context behind what the rates are and what those associated payments are. So they really can see a side-by-side comparison of, oh, kind of thought it was going to be a lot more than that. Well, okay, maybe I'm a little more comfortable now with a payment of X if the rate is X.
We talked before, and that's one of the things you say when you have first-time home buyers come in. And one of the things I like to ask them, because I learned that from you a couple years ago, is what do you want your payment to be? Everyone's like, well, I don't want to spend more than $250. Well, they don't even know what $250 means in a payment. So instead of thinking of that big number, like if you're paying $1,200 now and you're buying something, are you comfortable paying $1,500 and reverse engineer?
Yep.
So is that kind of the conversation you're having with first-time home buyers or buyers in general?
Buyers in general. I call it top down, bottom up. And I finally figured out why I call it that. And the way that my system is structured is you put in our purchase price, down payment gives us the loan amount. Then right next to it, a little further down on the page, it gives us the payment. Okay. So I start with, hey, what do you want your purchase price range to be? $250. Fantastic. Okay. What's your down payment? 10%. Okay, we're going to finance $225,000. Here's what that payment is going to look like.
Oh, yeah.
And then I do bottom up. What do you want your payment to be? You say, $1,500. Okay, still the same down payment? Yes. All right. We're going to reverse it. And here's that purchase price range that you need to look at.
I need that app. Can you show me? I'm sitting here like trying to do the math.
I am the app. You just always call me.
Like, Ashley, can you do that? Because it is concerning because people don't really understand how the payment works because they go on like a website, a third-party vendor who says, well, they're not including taxes, they're not including homeowners insurance, or sometimes they're included inflated numbers for those.
Yep.
Or if you have an HOA.
Yep.
So many things.
There's so many variables, and I would rather do the hard work and know that it's correct.
Yes.
Then and there are so many mortgage calculators. I think even on some of these websites where you can search for homes, they have a mortgage calculator on there. But it defaults to 20%.
I saw that.
Not everybody has 20%.
Like the bankrate.com where you can go on those and it always defaults. And I'm like, most of the buyers don't have 20%. You don't have to have 20% to buy a home. If you thought that is incorrect information. So please talk to a licensed realtor or mortgage lender in your neighborhood because you don't need 20%.
Correct.
So what are you seeing in terms of negotiating? Are you having a lot of buyers who are losing out on offers, or do you get part of that conversation when they call you and you're doing pre-approval specifically for a price?
Yes, is the short answer. Yeah. So I am a huge proponent, instead of a negotiating tactic sometimes is you're going to come in lower. This home's been on the market for
5 days.
Right? It seems like that's a long time now. Yes. But a home's been on the market for an extended period of time. And so buyers automatically think, well, we'll just offer less.
Yeah.
Okay, what if instead of doing that, you ask the seller to cover some of those costs, and now you're instantly saving out of pocket whatever that dollar amount is that you're trying to negotiate for that seller credit. So again, I like doing that comparison because then it puts it into, oh, okay, side by side. Let's go this really route. Yeah, let's go whatever route makes the most sense. But
and everybody likes to have less. I always look at it like when we're asking for a seller to give us closing cost credits, even if we finance that in, meaning that the purchase price is $250, but we need $5 in closing costs, we're going to pay $255. you're still, that payment on that 5,000 is so minimal. And I always say, how many months would it take you to save that 5,000 that's in your bank account? And wouldn't you like to use that to buy your washer and dryer?
Exactly. There's so money. Obviously, money can be used many different ways. But I love making money work the best for my clients.
Yes.
People call me crazy, but I have clients that say, "Hey, I want to put down 20%," and I say, "Are you open to looking at paying off debt? Oh, you have a car loan with a $500 payment. Would you be willing to take some of those down payment funds to pay that off? And now you don't have a $500 car payment.
And your payment didn't go up that much.
And your payment, I mean, sheesh. So,
well, that's what I like about working with you and how you do your businesses. You're a holistic. You're not just looking at buying the house. You're looking at how does it work for all of your money and all of your debts and expenses. One of the things that I heard from another lender, and I don't know if you've experienced this as well, is what he's seeing is a lot of people aren't able to qualify because their car payments are so high. Like with the interest rates on car payments these last year, has that really changed what you're seeing for payments? Like $1,000 a month, I heard something.
I've seen some pretty crazy car payments.
Yeah, like, and that affects your debt to income ratio.
Affects your debt to income ratio. Yes, I have seen. I don't know. There was like a truck payment of like $1,500. A brand new fancy, big old like 3,500 big hunk of, drove it to closing.
But cost of everything went up because interest rate doesn't just affect the mortgage; it affects your credit card payment, it affects your car loan payments, and all of those things. So how are you helping people to, like you said, maybe pay off that instead of doing your down payment, or reorganize it so their debt to income stays? What's the number now you have to be at, your debt to income ratio, depending on the loan? Let's say for an FHA.
FHA? 55.
Oh, wow.
we have wiggle room, and if a borrower makes sense and they have that flexibility and we can get the file to run and all the stars align, we have some flexibility with that debt to income ratio. For conventional, it's pretty much at 50, no higher than 50, 49.499.
I remember when it was like 38 or something.
It's crazy how times have changed. And there's different, USDA has their own. We have a portfolio product, our in-house loans. Those have different requirements. So I guess there's really not a one size fits all.
So every program has a different thing.
Exactly.
But so even if someone says, well, God, because they're thinking in their head, when I rent, I have to have this much for. But buying a house, really, you have a little bit more flexibility because they don't count your rent, obviously, payment. They're just looking at your monthly payments on that credit card, not the total balance.
Exactly. We focus on the monthly payments because that's what you're paying or expected to pay. That minimum monthly payment. If it's $25 and you pay $100, we're going to count the $25.
That's your debt.
Exactly.
So that's something I think when I talk to people, they're like, oh, well, I have credit cards, I have student loans and all this stuff. And I'm like, you guys don't holistically look at the full number, except you're looking at the payments. So, because everyone's student loans are going to come back payment dues in June. So with that, for people who are looking to get pre-approved now with that getting ready to start again, how does student loan payments impact? It's all part of your debt to income ratio? And is it weighed the same as everything else?
So it is weighed a little bit differently.
Okay.
And even through forbearance, I'll just talk about my company and how I do things.
Of course.
Per guidelines, I was counting payments on federal loans of 0.5% on FHA and Freddie Mac, which is conventional, and then 1% on Fannie, which is conventional. So there's a difference between Fannie and Freddie. And then with VA has a totally different calculation. It is 5% of the balance divided by 12.
Oh, okay.
So I was still factoring these in, even though they are in forbearance, and people will look at their first set of loan documents and say, hey, there's a payment on here. I'm not paying this.
Have to pay it.
You're going to eventually.
In
exactly.
In the 30-year span of your fixed rate mortgage, you're going to have to pay it.
Yep.
So that's great. I hope, I don't know about other lenders. I haven't asked that question to anyone else, but I hope everyone was being forward thinking, because if not, when people get these $400 or $500 a month student loan payments, that's going to be a shock. Sting a little bit.
Yeah. Sting a little bit. So
what is the most pressing thing you think people need to know about what's going on with interest rates and the hype in the media and all the things? Turn off the news is what I say.
Yeah. Interest rates are so relative. It's like when you ask somebody, what's expensive? Oh, that's expensive. That coffee, that's expensive. And some people have a Starbucks every day.
Some people think that dollar McDonald's coffee is like, that's their special treat.
Exactly. Relative. So everything is relative. So you had mentioned something earlier about high credit card percentage rates. I have actually had borrowers do debt consolidation, do a cash out refinance at a 6 or 7% interest rate to pay off
those 20s.
Yes. And they just never thought about that because all they could focus on at that point was, oh my gosh, rates are so high. And we actually saved them so much money by strategically looking at all of their debts, paying off some of them with the highest interest rates and highest balances. And yeah, their mortgage payment ended up going up.
A little,
but now they don't have all of these credit card payments.
So if you're paying $200 to every credit card company, you're paying a little bit less to raise your mortgage. Oh, wow. People don't even think about, and you know, everyone talks about equity in your home because right now people have more equity in their home than they have ever because appreciation went from like 1.8% on average to like 16%.
Skyrocketed.
How do you use that equity to work for you? And that's something I've been working with my sellers who are afraid to move because they don't want to get the new interest rate. I'm like, everybody wants to sell in a different market than they buy in.
Yep.
And that doesn't happen. You do it at the same time. So like you said, use that equity to pay off other debts, pay off student loans, pay off, you know, I know when rates were really low and people couldn't find homes, they were renovating their home. I don't know if people are still doing remodel HELOC loans or what that looks like. They are still doing that?
That and bridge loan is the other common thing lately.
Oh, okay. So they don't want to be a contingent. Bridge loan means you're not contingent. I can buy this house without selling this house, and then I have a time period in between to sell that.
Yes.
What's that time period typically look like, or is it anything?
For us, it's 12 months.
Oh, wow. Okay, that's nice. I thought it was like 90 days.
You go so quick.
You gotta get that house going.
Yeah, you gotta go. There's so many ways to be creative. And again, I use the word strategic because I'm a planner. And sometimes in mortgage land, it is very difficult to be a planner because things change constantly. It's so fun.
Yeah. But the overall theme of what you're doing stays the same. It's like real estate.
Exactly. You guys are the thing that's changing.
Yeah. Well, so have you had a lot of people in the discussions doing buy downs? Because I know we talk about everyone having equity. Are people using that equity to sell now and buy down rates? And what does the buy down look like? Is that a 30-year buy down? Is it a 1-year buy down? Or how does that work? So
there's two types of buy downs. There's, you know, the typical traditional paying points, which is buying a lower interest rate for the life of your loan. So hypothetically, let's say that rate is at 6.5% today. And you want a 6% interest rate. You're going to pay X points, whatever that is.
I've never understood the correlation between the points and the dollars, and I know it's very complicated with fractions and stuff, and fractions are not my thing. So let's just do random examples.
We'll just do a random example.
Do not quote this to your mortgage lender. These are just examples.
Yeah, exactly. So let's say it's just for ease, $100,000 loan. Loan amount. So they're financing $100,000. 6.5% interest rate, but they want a 6% rate. Let's say that costs 1 point. 1 point is 1% of the loan amount. So in this case, $1,000.
Not too shabby.
Not too shabby. Okay. So then let's say now that you say, I want a little bit lower than 6. So we look at 5.75.
Thank you for not saying 5 3/4.
Oh God, yes.
Because I'm like, what does that mean? I've been doing it for 15 years.
Think like a gas gauge.
Oh, yeah, cool. Oh.
Those are in 8.
Good to know. But my car doesn't have that. It's all digital. It's like, look at a watch.
So let's say that they say, hey, what is 5.75? let's say that is 1.5 points.
Okay.
That means it's 1.5%.
So 1,500.
1,500.
Okay, I know money math.
Yes, exactly. Money math, money math. So there's not a 1-to-1 ratio. 1 point does not equal 1 percentage point.
Okay.
So I like to go over those options. Sometimes it makes sense, sometimes it doesn't. I look at the recoup cost.
Okay.
So what is the difference? Exactly. What's the difference in payment? $50. How long is it going to take you to then recoup the $50 difference if you're paying $1,000?
It's cash on cash return.
Yes. 20 months.
Yes. Well, good to know. It's like in commercial real estate, that's how people assess their properties they buy. Like, how long does it take me to recoup that? Where's my cap rate? Like, it's the same, but you're doing it in a residential home.
Exactly.
Okay. And so what's the other type of buy down?
So there's something called a temporary buy down or a 2-1 rate buy down.
Okay.
And for the easiest way to explain that is that the first year it is 2% less.
Oh, okay.
So if the base rate is 6.5, the first year you're at 4.5.
Okay.
The second year you're at 5.5. The third year you're at 6.5.
And are you fixed at 6.5?
And then you're fixed at 6.5.
Oh, so it kind of side.
Unless you have an adjustable rate mortgage, but let's talk 30-year fixed.
Okay. So that's kind of nice too, because you know you're never going to go higher than what this rate is. So if this rate is now 9.5 in 3 years, you're at 6.5. So it's kind of like back in the day when they had the ARMs, which are people, I don't even know if people buy ARM loans anymore. Or
they're not as competitive, and I think the thought process behind that is everyone's so refi. Once rates drop, that the incentive is no longer there. It's towards the 30-year as opposed to the ARM.
So the buy down's more of a better option because you know at the end of the day you're going to be here. Potentially.
Potentially.
And what is the cost to do a buy down with that same 100,000 example? Is it the same as the
same
points
theory behind it, same points behind it? It's just more points for a lower rate.
Okay, because you're going 2%.
You're going 2%.
Half a percent. Oh, okay. So you really have to put some money into that one.
Yeah.
Okay.
Yeah. So fun.
Yeah. So it's so many complicated things. That's why I always say, I mean, you are watching a video on our podcast about this, but talk to your local lender. And Ashley, you do mortgages all over the country, pretty much. Yeah.
Every state except Maryland.
Oh, okay.
Yeah.
And can you tell them all your certifications and all your things?
Sure.
So, because in case they want to reach out to you to ask questions or to help them with their purchases.
Oh yeah, I love when people ask questions. So I am a certified VA home loan specialist. It was a credential that I got right when I started. I was so excited. It was like a 6-week course and so nerdy about it. But with my husband, Kyle, being in the military, I just wanted to really dig in and understand VA loans. I also work with 4 different grant programs. One of those is national.
Oh, okay.
So there's some grant program options there.
And you have the 3 Kansas grants you work
The 3 Kansas grants that I work with as well.
So hard for you to brag on yourself.
I know. I never talk about myself.
One thing I will say about you is you're all about education. You're all about helping your client find the system and the process that works best for them. And I've always felt like you were very no pressure. So people can come to you and work through all the scenarios, which, you know, I think part of that comes from your housing counseling background, working with people to get into housing. Which you forgot
about that.
How they fit into housing and just really having a servant heart to go out there and really help people establish something. Because I always say real estate is one of the best ways to grow wealth and generational wealth through owning something that you also live in and finding ways to use those tax benefits to your advantage.
Yeah.
We don't have to talk about taxes. That's a terrible thing. Everybody's just almost done mornings out of it.
Right, exactly.
But I do appreciate, is there anything else that if you were to predict what we were going to see for rates, because I'm going to put you on the spot now. I've read all the economists. I'm seeing everyone giving these guesses. Are we stabilizing? Are we going to go down? Are we going to go up? And I agree with you say, quit telling people you can just refinance later. Make the payment that you can afford now and for the future. And it's a bonus if they go down and you can refinance.
Exactly.
So don't stretch with the expectation that things will change.
Exactly.
Because the economy is changing.
If I had a magic ball, oh, they can't see
They
this.
can't see. Put the globe in the middle.
If I had a magic ball,
where are we landing?
a crystal ball, I think that I was reading an article this morning, and rates right now are the highest that they've been in 2 months.
Mm-hmm.
So we started to see some improvement, and then we spiked, and then some improvement, and then we spiked. So there's always going to be that ebb and flow.
Yeah.
I think that timing depends on the house, depends on the borrower, and if the right house comes on the market and you can make it work, whatever that looks like.
We say buy the house, date the rate.
Yep.
But be okay with marrying the rate if you have to marry the rate.
Exactly.
Well, she won't give a prediction. I'm going to project with all of my expertise and knowledge. Anyway, I'm going to say we're going to end the year at 5 3/4. I'm going to be optimistic. What were rates today? Because I don't.
I haven't even checked the market.
But yesterday, 6.5 maybe. This will come out. So this is as of May 17th. So
let's see. I'd say like mid sixes.
Okay, so yeah,
between government loans, FHA, VA, and then conventional loans. But and this is for another day. But there's all of those LLPAs that I'm sure you've heard about.
Yeah, well, the FHLP.
FHFA.
Yeah, they actually are going to stop that. We just got a legislation passed through NAR at our meeting last week.
For DTI.
Yes. So there's some pieces of it. That's a whole other conversation. We're already overwhelmed, Ashley. Where can they find you on social media? Where do you put your content out? Can they subscribe to get your information? Drop all your stuff.
All of the above. So I am on Facebook as Ashley Home Mortgage. I am on Instagram as ashley.home.mortgage. I am on LinkedIn. I put a lot of content on LinkedIn. It has some of my Zeller's tellers that are just quick. It's been a while. Quick little updates about what's going on in the market. And then ashleyhomemortgage.com is where you could fill out an application and get, all of the CRM stuff that comes from that.
There you go. Well, thank you guys so much for tuning in. I do know the market and real estate is so fluid. It's constantly changing, but I really wanted to give us a touchdown of like, hey, where are we at now that we're in that second quarter of 2023? And I appreciate you being on the show.
Absolutely.
Thank you.
This episode of Crystal Spod Mag Celebrating Women in Business is brought to you by our sponsor, Crystal Clear Realty. Buying or selling, the choice is crystal clear.